Well, today we're going to look at moving averages, a very commonly used technical indicator that people overlay on their charts. But I kind of want to show you a different way of using them compared to how you're typically accustomed and generally taught in technical analysis textbooks, technical analysis classes. So we're going to walk through some very basic things here, and ultimately we'll get to a model that I've been using myself for over 30 years and having taught institutions for about 25 years already. So let's just start off. Obviously, we know that moving averages are a simple filter. Some traders use a simple moving average and a single moving average as a filtering device, bullish above, bearish beneath. So here, let's take a look at something like the NASDAQ comp. This is actually, it's a 30-month moving average. It's not weekly, it's monthly. So it's labeled wrong on the top. And here we show with a 30-month moving average going back 20 years, if you simply played above and beneath and use the moving average as your filter, you've done remarkably well in 30 years. Using the same NASDAQ comp, but this time looking at a weekly chart, you did pretty darn well too. But you can see in the latter part of 2015 and halfway into 2016, you got chopped up many times, just getting long above, short beneath as it kept playing with it. But ultimately, we're long from middle of 2016 all the way to looks like late summer, early fall of 2018, in which in theory you would have turned short on the break and then got back long in early 2019, pretty much same place you got short, and you've been bullish since. So also same type, good making money. This is also, again, the weekly symbol here in the middle is wrong. It's actually a 30-day moving average on a daily chart. And you can see here that you'll still make money, but you certainly can get chopped. And all I did here was default to a simple either 30-day, 30-week, or 30-month moving average to give you the sense of what this says. Look at some other charts. Here's Home Depot with a 30-day moving average. Same type of thing. You can capture some of the trends, but you can also get chopped up a heck of a lot. Here's where you get destroyed in something going sideways for a fair amount of time. This was Walgreens boots with a 30-week moving average. And from the middle of 2015, essentially through almost all of 2017, you just got clobbered. So there's pros and cons to using a simple moving average and a single moving average. So at some point, someone said, hey, let's use two. And generally, we'll use the interpretation that when the shorter term moving average, assuming if you use two, one of them is going to be less time framed than the other. So one by default is shorter. If the shorter term moving average crosses up through the longer term moving average, it's bullish. You get long and you stay long until that shorter term moving average flips down and goes through the longer term one, in which case you get out of your longs and you go short. Now, one of the things about this is this model, which many funds trade, will always be in the market. So there's never a time it's not in. It's simply taking the signal. So here, let's take a look at a nice trending tech stock for a while. Here's Micron with a 10 and 30 week moving average. The 10 is the red line. The 30 is the blue. And from early 2013, you got a positive cross, and you rode this all the way through just about early 2015. Made a killing on the upside, made a pretty darn good killing on the downside going into 2016. In the middle of 2016, this flips back to being bullish, and you would have rode it all the way until looks like about summer of 2018, where it got you bearish. You did really well, and now you're a little bit into choppy session. So this looks pretty good. Let's take Micron with a 10 and 30-day moving average, and you can see you can still make some decent money with this model, but there are going to be periods of time that you get chopped. Let's take a look at Boeing on a 10 and 30-day. Going all the way back to 2016, the lower left-hand corner of this chart, red crosses over blue, and you are basically in this, the bulk of the move. Occasionally you might get knocked out, but all the way into early 2018, this would have kept you long. And then in 2018, it would not have been a fun year because you almost always paid higher than you sold and almost always sold lower than you paid. You caught a decent move in the early part of 19, and it's you've given back a fair amount of that just with the choppiness. Here's Boeing on a 50 and 200 day, and I switched the 10 and 30 purposely to 50 and 200 because this is what so much of Wall Street looks at, and for no particular reason other than it had appeared, I don't know, 30, 35 years ago in somebody's written work. And ever since, it was sometime in the 1980s, someone wrote a piece that included 50 and 200 day, and all of a sudden that's what everybody looked at. And so here, if we look at this on a daily chart for Boeing, going back to 2016, same type thing, you're in a bullish mode. It stays bullish until the end of 2018. And then you unfortunately buy very high in 2019, not far from, I don't know, maybe $20 from the top or so, and then get knocked out at, I don't know, looks like about 355 or so, and you'd still be short at 355. So what happens is you get pretty, you get decent results, but sometimes it's really bad. So leave it to Wall Street to say, well, if 1 is maybe okay and 2 looks better, let's try 3. So somebody came up with 3 moving averages. I think this was late 70s to early 80s. And here what they would try to do, and this first showed up, as far as I know, in the commodity markets. They would use 4, 9, and 18-day moving averages. When the 4 crossed up through the 9, it would mean don't be short. When the 9 crossed up through the 18, it would be a get long signal. And you would hold that until the 4 crossed down underneath the 9, in which case you covered, you exited the long. And if the 9 crossed down then underneath the 18, you'd actually go short. So that was the method. It didn't work particularly well at all. So I had been looking at this stuff for years because I grew up in the commodities markets. I actually started trading in the pit in 1981. And in college, I was already trading futures from my dorm room. And when I graduated, I started in the pits. Actually, sorry, in 1983, I started in the pit and was there until 1995, trading stock index futures, gold, silver, copper, sugar, and cocoa. So I've traded all those markets in the pits themselves, and often would come into the pit each morning looking for these potential crossovers off of daily charts. Would I see fund selling coming in or fund buying, etc.? What I realized was it did not work very well at all. But I knew there was a good concept in moving averages, but I realized that more often than not, crossing moving averages did not indicate trend. They actually indicated lack of trend. And that was almost completely opposite to everything I knew I had been taught about how to use moving averages and crossovers. So about, let me think when this was. By mid-1980s, I developed a TMAP model. I trademarked it. It's called TMAP. And I find that it's one of the most effective tools that you can use in order to figure out when a trade starts, the continuance of the trade, and the trend, and most importantly, the conclusion of a market trend. And I have taught this to hundreds, if not probably thousands, of Wall Street institutional traders and portfolio managers who over the years have come back and told me that this is the single most important thing they will look at just to get a sense of where you are in a general trend and if there's trend. So what's TMAP? Well, it's really simple stuff. You can do this on any charting package. You set up 3 moving averages. Typically, I default to 20, 35, and 50, and I use simple moving averages. What I want to see for a buy signal is price to get above an upward sloping 20-period moving average. The 20 needs to be above the 35, and the 35 needs to be above the 50. Essentially, I'm going to want to see all 3 moving averages having positive slope, and at a minimum, the 20 and 35 having positive slope, because the 50 is the slowest. Sometimes it is going to take longer for that to show positive slope if you're coming out of a sideways move. So sometimes if I like everything else I'm seeing about the stock or the ETF or whatever it is I'm trading, I may jump in already when the 20 and the 35 are already positive slope with price above the 20 and 20 above the 35. And the other thing I like to see is the bottom bullet point here, all three moving averages having some sense of spread from each other, almost appearing parallel. And I'll show you what that looks like in a second. A downtrend would be the exact opposite. I need price underneath the 20-day or 20-week or 20-month, depending upon what time frame I'm looking, moving average. The 20 needs to be beneath the 35. The 35 needs to be beneath the 50. All three moving averages having negative slope, or again, the 20 and 35 at least having negative slope, and the 50 looking like it's getting there. And all three looking somewhat parallel to each other. So what this does is tell me when stocks or whatever it is I'm looking at, it's truly rallying and really worth buying. When markets are going nowhere and needlessly tying up your capital because you get in a position that is not going anywhere. So you're wasting your money in potentially finding something that can return you capital, make money, essentially. And when markets are truly declining, giving you full-scale signals that you don't want to be long and you essentially want to be short. If you play the short side of the market, there are some individual investors who simply just don't play the short side. So let's take a look at it. Here's Apple with TMAP on a weekly chart. And let's go to the lower left-hand corner. So the deep blue line is the 20, in this case, it's a weekly chart, so a 20-week moving average. The red is the 35, the green is the 50. Somewhere in late 2013, early 2014, you have the sense of what this signal is saying. Now, notice that price in, looks like February of 2014 gets underneath the blue, the 20-week moving average. So it's not a buy again until it breaks out above. And as long as you're seeing price generally leading all three moving averages as they're spread apart from each other and appearing somewhat parallel, they'll never be perfectly parallel, but you can see this sense of being spread apart, you have a real trend. So let's look at the first third of the chart on the left-hand side, pure bullish uptrend. We'll talk about what happens in the middle of 2015 in a second. From middle of 15 to middle of 16, you're in a downtrend. From middle of 16 all the way until the end of 2018, you're in an uptrend, and ever since, it's mishmash. And the moving averages are crossing over each other consistently, and that's why I also say it tells you there's no true trend when moving averages crisscross. So let's look at how do you get out of this? In this case, there's two things I look at to lighten up. One is if the lead moving average, the 20-week, goes flat, by necessity, it has to mean that that underlying security is not going anywhere. We all know what moving averages are. We all know how they're calculated. So if the lead moving average goes flat, then it means the underlying has stopped going up at a minimum. So when I see the moving average go flat, the 20, I often take off half. And I get out of the other half when it breaks underneath the 50-week, the green line. That's how I exit. Now, on this trade, you would have gotten half out in the middle of 15 and certainly half out on the first or second week that you closed under the green moving average. Still made very decent money. This now sets up over the next several months as a bearish trade. And you have price under the 20, 20 under the 35. Look at early 2016, late 2015, and the 35 under the 50. All right, so you can lean into the rally, you sell it, and it comes down again. You see in the middle of 2016, it flattens out. The blue line flattens out, means it's no longer doing what it had done. Take off half. Why? Just because the trend has potentially changed. You don't know for sure, but something different has occurred. If something different has occurred, that's enough for me to take half off. A week or two above the green gets me out of the short, and you can see by late 2016, early 2017, this goes back into an uptrend. And even in early 18, when we got beneath the 50 week, we didn't close beneath the 50 week. So might have been afraid, but if I simply use this, and notice I took every other model off, and I'm not suggesting you simply only use this, but what I've purposely done here is taken everything off the chart, every other indicator I use. You know that if you've heard me before, you know I use institutionally based models. That this is not typically what we would call an institutionally based model, stuff that's more sophisticated, that times the market in a different way. But what I want to show you is something that I realized about moving averages years ago. So let's take a look at, here's a more in-depth look at the Apple chart just more recently. And again, you can see towards the January of the latter part of 18, you lost positive slope. Either going flat or losing positive slope in the 20 indicates that there's a potential change of trend, just like it did in here. It told you the market was consolidating. Now, even if you sold out of half, it turned back into a bullish signal on this large bar higher. So you would have gone back into full long position. But you can see as of recent, it's much more choppy, even though there is a general uptrend here. Within the context of this large decline that we saw in late 2018, you're still in a choppy market. Here's WTI oil. One of the toughest markets to trade is the oil market, and yet this at least gave you two really solid trades, if not three. So if you go all the way to the far left, you actually were in bullish mode from the fall of 2018. It peaked out. You made a little money. Future traders always go short. These are people who go short. So you could have captured a decent amount of this decline, a large portion of the up move. And then here, since spring this year, you know, kind of down move, and then you get chopped up and really nothing since. Look at gold. Now this is Dees gold. It didn't have a continuation chart, but you can still get the sense of the bullish move in the early part of 19, the bearish move, or at least choppiness, and then since June, middle of June, straight up move. Cotton, straight down move since May this year. Copper, choppiness in 2018, two moves this year to have captured some of. You're not going to get all, and of course, with a moving average model, you're never going to get close to buying the low or selling the high. We all know they're lagging indicators. So this is different than a lot of other models I use, which actually play in the second and third standard deviation of price activity. This is much more geared for the first standard deviation to play the bulk of the move and leave the tails out of it. This is 3M. Since 2016, you caught a very good chunk of this. Towards the latter part of 2016, notice that you went completely flat. You would have taken half off. But by your early 2017, you're getting spread again. By March, price above all three. They're spread apart. They're all positively sloped. You get back in bullishly. And again, you would have gotten out of some price-wise on this bar down in here. And certainly within, let's say, 2 bars of getting under the 50, you would have been out. Spiders. Look at this on, now this is a monthly chart. You try this with the spiders on a daily and it gets chopped up. Look at the long-term trend of the market. So this said from 2009 to middle of 2011, late 2011, choppy, hard to really figure out. By early 2012, this is very clearly defined which way to play. And you'd be in it ever since. Now, one of the last charts I'm going to show you is, I call this Does It Matter? And the reason it doesn't matter was, and this is a slide I used 15 to 20 years ago, and I still have it, because it doesn't matter that this happens to be an old slide. The point is, if I had software, and I don't think I could do this on StockCharts.com, which is why I didn't put it up in here, and look for something more current. If you saw this chart, would you know how to play those 4 moves without even knowing what that was, what the underlying security was? You wouldn't need to know. This could be anything, and you'd be able to figure out how to play it. Now, what was it? By chance, it happened to have been a CRB back then. And you could have either played CRB futures or the major components of CRB. But this was the CRB index from the late 90s to about 2003. So what I'm showing you here is if you could see trends like this, so clearly defined, then this model shows the robustness of what it does, because you could essentially trade anything. You don't even have to know what it is. You just have to need to understand this simple model. So that's what I wanted to show you about using 3 moving averages. The most important things, again, price above for a bullish signal, price above the 20 above the 35, the 35 above the 50, all 3 positively sloped and somewhat spread apart from each other. That's a bullish signal. Bear signal, exact opposite. Price underneath the downward sloping 20, the 20 is underneath the downward sloping 35, the 35 is beneath the downward sloping 50, and somewhat spread apart from each other, somewhat looking parallel. We've got a pure bear market. So,
excellent.
In our institutional newsletter, over the last year to date through August 2nd, I'm now up actually about 73% this year. But officially, until I do the month-end results, 69% this year. Last year, we made 24%. In 2017, 75%. The profit factor is something you should know about when you're comparing whether it's newsletters or hedge funds you might invest in. This is dollars made. It's a ratio of dollars made to dollars lost. So this year, you would have made $9.20 for every $1 you lost on my recommendations. Last year, $1.74 for every dollar lost, and that's just fair. But we still made 24% in the year that the S&P was down. And then in 2017, $6.67 for every dollar made. So I'm sorry, for every dollar lost. So anything 2 or better is considered quite good in the industry. So this is what we've done. Erin, I will turn it back to you if there are any questions.
Yes, there are some questions. I use the 20, 50, and 200-day EMAs for decision point analysis. That's how we get our market timing signals. What do you think about EMAs versus simple moving averages?
I typically use simple because they're the simplest thing often to find on a charting system. They've always worked for me. And the EMA is going to obviously put more weight on the most recent information, and therefore you could get flattening moving averages kicking you out of trades too soon. Mm-hmm. So that's why I'm content with just a simple moving average.
Right. And I know everybody sort of has their preferences. Do you base your analysis on always on those weekly charts?
Nope. I look at daily, weekly, and monthly. And ideally, it's great when you have all 3 say the same thing. Doesn't happen that often. I mean, in a rip-roaring stock like an Amazon's been up until maybe a year ago, you can often find all 3 giving you the same signal. But I like to look at all 3. But for medium-term investing, I'll generally look at a weekly chart.
Okay. Excellent. That pretty much covers the questions. They all sort of centered around the application of an EMA versus a simple moving average. And I found it interesting. Somebody was asking about specifically the 20, 50, and 200 days. If you've thought about applying those. Like, no, it doesn't. He doesn't need to do that. I do that.
Now, people often ask me why 20, 35, and 50 are these magical back-tested numbers? And the answer is no. It's they're just I like that they're uniformly spread from each other in the sense that there's 15 time periods in between the 20 to 35, and the same thing to the 35 to 50. I've looked at other ones, including some people like to use Fibonacci moving averages, so you might want to use 21, 34, and 55. You certainly could use anything you want. Those obviously are not equally spread out the way 20, 35, and 50 are. If you have a really solid trend, almost any combination without going out to 100 or 200, something really far away from the shorter ones, will work. If you tried to do 50, 100, 200, you'd have a heck of a hard time coming up with frequency of all of them being in the right place at the right time with the right slope and the right spread. That's why I tend to stay 50 or less in these numbers. And it's just stuff that's worked for me. So I don't go less than 14. I don't go more than generally 20 for the first one. And then it's just a matter of, finding a spread in between them that I feel comfortable. But when I first came up with TMAP, I used 20, 35, and 50. I'd like the idea that it was just a really simple model to use. Any technical analysis software could put up, moving averages easily. And I tried to keep it really simple. So, you can play with this. You can try to back test. The thing about back testing is you're going to find it'll work perfect on one. And you might find a stock that has a particular rhythm, and you can fine tune these moving averages to try to get a little better feel for any particular security. But you'll find that it's not going to work uniformly. I like this because generally it works across anything I look at. And important to realize too is you may get a very ugly looking picture on a daily chart using 20, 35, and 50. And if you do, instantly move out to a weekly time frame. Anytime something's too choppy to get signals that are working, go out a time frame. If the weekly is all choppy, go to the monthly to get a sense of where's the long-term trend. So this is not going to be a 3-week trade. This is something, if you're looking at a monthly chart with 20, 35, and 50 month moving averages, this is more of a long-term investment type idea. But try to find a time frame that aptly suits this model. And that's the time frame you should use it for. So if it's too choppy in a daily chart, look at a weekly. Even if the weekly is sloppy, look at a monthly.
Mm-hmm.
Okay, one final question. We have about 30 seconds. I saw the XLF financials broke out above the May high back in July, and then since have kind of fallen back. Mm-hmm. Now, that was an absolute price breakout, but on a relative basis, financials have been struggling. So if you see an absolute breakout, do you also look at relative strength, or do you just simply base it on the price action?
Well, generally, I like to buy stuff in sectors that are outperforming in the first place. So I'm going to be more apt to buy into sectors I like, and less apt to buy into energy and some of the other healthcare ones that are you're fighting trend just in relative terms. You might make money in absolute terms, but you probably could have found something better if you were just in a different sector. So generally, I would say to listeners, you want to buy outperforming sectors and stay away from underperforming ones, just as a general rule.
All right, one final. I'm going to slip one more in because there was a last second question just came in. If you were looking to add to the S&P 500 right now, to the SPDR, what would you be looking for to make that decision to add?
If I were going to buy SPDRs, at this point, I'd be looking for not stuff from this model. I'd be using a Tomoric propulsion buy signal. I would be using a Tomoric setup 9 count on the downside, or a propulsion exhaustion signal on the downside. I'll either buy strength, where the signals show up to do it, or by weakness when and if time appropriate.
Okay. And if somebody wants to follow you and follow your newsletter, should they go to inthenowtrader.com?
That's the place to go. Lots of videos up there, as well as information on how to subscribe.
Okay, awesome. That's In the Know Trader. That's KNOW. inthenowtrader.com. If you want to follow Rick, we would certainly encourage you to check out his website. Rick, always a pleasure to have you here. We look forward to getting you back soon.
Tom and Aaron, thanks so much. I appreciate it, and enjoy the very little bit left of summer.
Indeed. You as well.
Thank you.
Bye-bye.